Good morning, everybody. Welcome to Ekcel Academy. I am CS Swati Sharma and we will be dealing with securities laws and capital markets in today's class. Our exclusive topic for discussion is capital market instruments. Yes, so let's begin the discussion for today. Before understanding what are the different types of capital market instruments, it is very important for us to understand as to what is a capital market. So the capital market is a part of a bigger market, that is the financial market. The main objective of the financial market is to provide the money to the borrowers. And who provides the money to the borrowers? It is the lenders. Right? So the lenders are going to give their surplus money to the borrowers, and this transaction of transferring the money from the lenders to the borrowers is going to take place in the market, which is known as the financial market. So the main function of the financial market is to mobilize the funds and put it into productive use. So there are so many investors in the market who have a lot of savings. Keeping this savings in your bank account, the money is kept idle. It is not in use as such for the development of the economy. So what does the market do? All the savings that the investors have, they can give it to the businessmen, to the entrepreneurs who are in need of capital to run their business. So this market facilitates the transfer of the funds from the investors to the ultimate businesses or the industries or the government for putting that money into productive use. Now let us understand that the financial market is also divided into two aspects. One is the money market and the second one is the capital market. Talking about money market is that market where the investment is short term, where the investment is for a short period of time, where the maturity is between 1 day to 1 year. So any kind of short-term investment is called as the money market investment. A few examples you can take is the treasury bills, the commercial papers, the certificate of deposits. These are a few examples of money market instruments. Now talking about the regulator of the money market, it is mainly regulated by the Reserve Bank of India. It's the primary regulator of the money market. Talking about the players in the market, since a money market is short-term investment, it involves a huge volume. Means the amount that you invest is very high, and because you want a high value of investment, the number of people who are involved in the money market instrument or transactions are very few in number. That is why we say that money market has small number of players, but the number of players who are there in existence in the money market do large volumes of trading. Coming to the capital market, it is the medium term and long term investments. A few examples, all of us that we already know in the general scenario that we see is the shares, the stocks, the bonds, debentures. These are all the examples of capital market instruments. The main regulator of capital markets is the Securities Exchange Board of India. This is the primary regulator. However, the regulator has to act in consultation with other authorities like the Reserve Bank of India, the Insurance Regulatory Development Authority of India, the PF Regulatory Development Authority. All these are also regulators of the capital market, but the primary regulator is the Securities and Exchange Board of India. And one of the major constituents of a capital market is the securities market, which is further subdivided into primary market and secondary market. We are not going into details of those market because our main entire focus for today's session is capital market instruments. So the instruments that we are going to deal with today are the instruments which will have long-term investment, okay, which is over and above 1 year. Is that clear? Can we move ahead? Okay, so in today's session, our entire session is dedicated to the capital market instruments, and this is a brief list of the 14 kind of instruments that we are going to study today. Let's begin with the first kind of instrument, which is the equity shares. All of us know what is a share. Share is nothing but a part of the share capital of the company. So a small part of the entire capital, if this is the entire capital of the company, a small part of it is called as the share. Now share will be categorized as different kinds on the basis of its characteristics and nature. The main kind of share existence in the country is the equity share, which is also known as the ordinary share or common share. If somebody says that I have invested in the shares of, say, Infosys, that means they have invested in the equity shares of the company. If they say that they have invested in preference shares, they have to specifically mention that they have invested in preference share. By telling that you made an investment in the shares, share simply means equity share. You do not have to specify that you have bought the equity shares. When you say that you have bought shares, it implies that you have bought equity shares itself. If you are buying any other kind of shares, you have to specifically mention as to what kind of share you have bought, right? So the equity shares are known as the ordinary shares or common shares of the company. They are one of the long-term financing options to raise capital. So this is a mode of raising capital for the companies where the people can make an investment in the share capital of the company. It represents the form of a fractional ownership of the shareholder in the company. So by having an equity share of a company, we are going to say that we have a certain amount of ownership in the company, and that is determined on the basis of a percentage. As to how many number of shares of that particular company do you hold, that will determine what is the percentage of your ownership in that particular company. So it is the number of equity shares that you buy will determine your level of ownership in that particular company. This is the basic meaning of equity shares. Let's begin to understand what is the definition provided under the Companies Act of 2013. Section 43 subsection 1 explanation states that equity share capital means all share capital which is not a preference share capital. So any kind of capital which is not specifically called as a preference share capital will automatically mean that it is the equity share capital. So the capital of the company is divided into equity share capital and preference share capital. So if it is not a preference, that means it automatically is the equity share capital of the company. Let's move ahead and understand what are the different characteristics of equity shares. First and foremost is that all the equity shareholders will have voting rights. Okay, let's discuss what are the voting rights of all the equity shareholders have voting rights. That means to say in which all meetings can they vote. We say that the equity shareholders have right to vote at all the general meetings. All the resolutions that are placed in the meeting of members, whether it is a general meeting, that is an ordinary general meeting or an extraordinary general meeting, any kind of resolution that is placed in the meeting of the members, the equity shareholders will have a right to vote at such a meeting. So here they do not have the right to vote at all the meetings. In the board meetings, they are not invited at all. So only the board of directors can vote at the board meeting. In the general meeting, the equity shareholders can cast their vote. So it is all general cast the vote. So if somebody says a statement that the equity shareholders can vote on every resolution passed by the company, the answer is no, because there are certain resolutions which are passed by the board of directors. In the board meeting, in those resolutions, the shareholders cannot vote. So the shareholders have exclusive right to vote in all the resolutions which are passed in the general meeting, be it the annual general meeting or be it the extraordinary general meeting. Right? And these votes will control the management of the company, because we know that if the company wants to take some decision, passing the resolution in the general meeting is mandatory. So ultimately, the deciding factor as to whether a particular resolution will be passed or not is in the hands of the ultimate shareholders, who are the owners of the company. So the shareholders have the control over the management of the company when they exercise their voting rights. Moving to the second kind of characteristics, they have the right to share in the profits of the company. How do they share the profits? There are two ways. First, whenever the company is having some profit, it can decide to declare dividends. That is, if you own one share, you will get a certain percentage of the profit that is decided by the company as a dividend for your investment in the equity share. And if the company wants to issue bonus share, the bonus shares are also given to the already existing shareholders. So you profits by the way of dividend and by the way of bonus shares. But one of the most important points to be noted, the shareholders do not have a right to the equity shareholders who are put last in the list. Once all the payment for all the creditors is done, all the debentures is completed, all the payment is made to the preference shareholders, lastly the repayment of capital is going to be done to the equity shareholders. So at the time of winding up of the company, the payment to equity shareholders will be made only after the claims of all the creditors, preference shareholders, are settled. So the people who are going to get the capital in the last are the equity shareholders. So these are the basic characteristics of equity shares, which give them the right to vote at all the general meetings. It gives them the right to share the profits of the company. That is, only in case the company is declaring it, they cannot demand for the share. And thirdly, they have the right to repayment of the capital only at the last stage, once all the other settlements are completed, that is to the creditors, debenture holders, preference shareholders, or any kind of credit that is due by the company to be paid to anyone else. So they are the last people who will be eligible to receive their capital. Any doubts, you can put it in the comments and we can discuss. Yes, so there is a comment which says, Chiranj is asking, without preference in dividend, apart from the decision making, what is the benefit of equity shareholders? So the equity kind of resolution. Shares which have vote. So if a resolution is placed and you hold one equity share allowed in the Companies Act, and as per SEBI, is the maximum votes that can be to the whims and fancies of the company. It has to be fixed, and if you want to change it, you have to follow the procedure for changing the same, right? So that by this, we know that if you have the ordinary equity shares, for one equity share, we will cast one vote. But the company also has the power to issue equity shares with differential rights as to dividend voting and otherwise, which means to say that for one equity share, you can have up to 10 votes that you can cast. Now, because one equity share has 10 votes that can be cast, it will definitely have a significant impact on the resolutions when they are passed, because they will have more number of votes. The equity shareholders having differential voting rights will have more power in their hands because they have more number of votes that they can cast. And because it is of such a great impact, there are certain conditions that have to be fulfilled if you want to issue equity shares with differential voting rights. The first and foremost being that it should be authorized by the Articles of Association of the company. If your Articles of Association do not specify that you can issue equity shares with differential voting rights, you cannot issue it. First, you have to make alteration to your articles, make provisions in the articles, and then proceed with issuing such shares. So the first and foremost requirement is that it should be authorized in the articles of the company. Second one is the voting power of shares with differential voting right should not exceed 74% of the total voting rights. So by this you will know how many number of differential voting right shares can be issued by the company, because with respect to comparison with the total voting power of the company, it can not exceed 74%. Thirdly, whenever the company wants to issue any kind of equity share with differential voting rights, it has to take the approval from the already existing shareholders by passing an ordinary resolution in the meeting. And fourthly, the company should not have committed some default. What are those defaults? First and foremost, the company should not have defaulted in filing the annual returns and financial statements in the previous 3 years. Secondly, they should not have defaulted in the repayment of matured deposits or declared dividend. Like I already told, if the company has decided to declare the dividend and they have made an announcement for the payment of dividend, they cannot go back. They have to mandatorily make the payment. And once they have declared, have they completed the payment? If yes, that means they have complied with the provisions. But if they have not paid the dividend, there is a default on their part. And such default should not be in existence in case the company wants to issue equity shares with differential voting rights. Is that clear? And third one is that they should not have defaulted in the redemption of preference shares as well as debentures. They should not have defaulted in the repayment of loans that have become due and which are payable. And there should be no statutory dues which are payable to your employees, whether it is any kind of salary or the benefits that they are receiving. So if you have made all these payments on time, you have not defaulted in any kind of payment that are due by the company, only in that case you will be allowed to give equity shares with differential voting right. So only if these conditions are satisfied, the company will be allowed to issue equity shares with differential voting rights. Yes. Yes. Now, we know that equity shareholders have the right to vote, but in addition to that, the Companies Act as well as the SEBI LODR regulations provide for certain rights of the equity shareholders. Let's discuss those rights in detail. Yes. The first one is right to vote, which all of us know. Second one is the right to subscribe in case of further issue. Third one is right to appoint a proxy and to attend and vote. So in case that any equity shareholder is not able to attend a meeting for multiple reasons, he has been given the permission to appoint somebody else as a proxy for him. On behalf of him, somebody else can come and attend the meeting and they can cast the vote on behalf of the equity shareholder. So he cannot do anything else apart from attending the meeting and voting at the meeting. Apart from that, no other right is given to the proxy. And if a shareholder wants to use this provision of appointment of proxy, he has to communicate it to the company much in advance that he will not be attending and somebody else will be attending the meeting on his behalf. Next is right to receive the copy of annual accounts. As and when the financial statements of the company are passed at the general meeting, they have to give it in the general public, in the public domain. And also, they have to receive these financial statements when they receive the notice of the annual general meeting. Next is the right to receive the notice of the general meetings. So all of us know that the general meetings of the members are called by the company, and at times it is also called by the shareholders themselves. But whenever a meeting is going to be called for, we should give a notice to all the shareholders that on so and so date a meeting is going to be called. This is the transaction that we are going to do at the meeting, and the details of what are the resolutions you want to pass at the meeting. All these things and details should be given to the members so that they are prepared for the meeting. They can come and attend the meeting. So this right to receive the notice is available to all the equity shareholders. Can anybody tell me what is the duration of notice that should be given to the meeting of members? For calling a meeting of members, what is the notice period that we should give them? Yes, you all can put it in the chat box. So if you want to call a meeting of the members, a minimum of 21 clear days notice should be given before calling for the meeting, so that they can make provisions for attending the meeting. So 21 clear days means 1 day of giving the notice and 1 day of receiving the notice is also included in the notice period. Next is right to inspect the statutory registers. That the Companies Act provides, and various other acts also provides, that the company have to maintain certain registers, whether it is the register of members, whether it is the register of the share charges that have been created. There are so many multiple registers that have to be maintained by the company, and these registers can be inspected by the shareholders at any point in time, that is during the working hours, and they can go to the company themselves or they can ask for electronic copies as well. Next is the right to requisition an extraordinary general meeting. So generally, it is the board of directors which call for the meeting of the members. But there are certain situations where the members want to raise some topic, they want to raise some business, or they want to raise some kind of discussion. At that point in time, even the equity shareholders can send a notice to the board of directors asking them to conduct a meeting on their behalf, and they want the meeting to be held. When they receive such a letter or requisition from the shareholders, it is the duty of the board of directors to conduct such a meeting. Next, going to the rights under the SEBI LODR regulations, they have a right to participate in the major decisions relating to the corporate changes in the company. Right to participate as well as vote at the general meeting. It is similar to what is provided under the Companies Act. Right to be informed about various rules and voting procedures. So all of us know that SEBI LODR regulations are applicable only to those companies which are listed on the stock exchange. If it is listed on the stock exchange, which means that it has a lot of investors throughout the country. And when a meeting is called for, it is not necessary that each one of them will be able to be present at the place where the meeting is being held, because the meeting will be held at a specific location, right? So in that case, the Companies Act has also provided for e-voting, right? And whenever e-voting are there, what are the rules? How should you log in? What are the voting procedures? How it will be considered as a valid vote? When it is not considered as a valid vote, there are so many things that have to be taken into consideration, and the details of such provisions should be communicated to the equity shareholders. So they have a right to know, to be informed about important details with respect to the voting procedures. Next is right to question the board of directors. So if there is any resolution that is being passed, you can ask them, why is this? What is the reason for it? How is it going to impact the company? Or any kind of news that they hear about the company, they can ask the clarification from the board of directors. Right to place items on the agenda of general meetings. They have the right also to propose certain resolutions. They have a right to participate in key corporate governance decisions. That is nothing but appointment of the board of directors. So ultimately, whenever a board of director is appointed, the permission should be taken from the general shareholders that we are going to appoint so and so person as the managing director or so and so person as the whole time director. Whatever is the designation, the approval of the members is necessary. So ultimately, they are the people who are going to decide who is going to be on the board of directors of the company. Next is the right to advocate shareholding grievance mechanism. Like I told you, if it is a company which is listed on the stock exchange, there are going to be n number of investors and they might have any kind of problem that they are facing, whether it is with respect to the voting power, okay, whether it is in respect of any kind of scenario within the company. They have any problem, there should be a designated authority to listen to their complaints, to give them a solution to their problems, to hear what are the problems that they are facing as an investor of the company. For that, there should be a proper shareholder grievance mechanism that should be set up by every listed company which is listed on the stock exchanges of the company. Right? So these are a few rights of the equity shareholders. Moving ahead to the preference shares, we know that any share which is not a preference share is an equity share. So other kind of share which forms a part of the share capital is the preference share capital, and we say that it is a preference share capital because they are given a preferential right over the other shares. And what is it? What is the preferential right that is given? It is the right to receive the dividend, and it is the right to receive the payment back of the capital when the company is being wound up. So preference shares are a part of the share capital of the company which carry certain preferential right with respect to dividend, which is at a fixed rate or a fixed amount. So they will say it is a 8% preference share, or they will tell an amount that so much interest is going to be or dividend is going to be given to the preference shareholders. So either a fixed amount will be given as a dividend or a percentage will be given to the preference shareholders as a dividend. And they will have a right to receive the repayment of capital before the equity shareholders. That is why they are given preference at the time of repayment of capital. So if these two preferences are given to any kind of shares, they are going to be called as preference shares. Now, what is the drawback of preference shares? Firstly, like I already mentioned previously, they have limited voting rights. That means they can vote only in those matters which will directly affect the rights of the preference shareholders, right? They cannot vote on all the matters that are placed in the meeting of members. Only selective resolutions they have a right to cast vote. That is why we say that the preference shareholders have limited voting rights. And because they have limited voting rights, they do not have a lot of control over the company in which they are holding the preference shares. Now, a very important point to be noted here is that there is a and it should be paid to them, right? And in case there is arrears, that means if there is pending preference share dividend that is required to be paid to the shareholders, in that case they will be given rights as that of the equity shareholders. So they say that a preference shareholder can acquire voting rights on par means equal to that of the equity shareholders if the dividend on the preference share is in arrears. That means it has been not paid to the preference shareholders. Now there are different types of preference shares. On the basis of accumulation of dividend, we can classify the preference shares as cumulative preference shares or non-cumulative preference shares. Cumulative means that if in first year the dividend is paid, second year the dividend is paid, in third year the dividend is not paid, in fourth year the company has to pay the dividend for the third year plus the fourth year, because it is cumulative. It keeps on adding if you don't make the payment on that particular year. So cumulative means you have to keep on adding the dividend for those years in which you have not paid the dividend. And non-cumulative means if you have not paid it for a particular year, the year is over and the fresh year start, it will not accumulate over a period of time. If for a particular year you have not declared it, it is okay. For the next year, if you have money, you will declare, or else you will not declare. And these terms and conditions will be decided right at the time of issue. When you're issuing the preference share, you are going to decide whether it is a cumulative preference share or whether it is a non-cumulative preference share. Talking about the second aspect, which is convertibility, the preference shares, like I told you, should have a maturity period. The companies are not permitted to issue preference shares which are irredeemable in nature. That means at some point in time, the maturity will come into existence. And on the date of maturity, you will have two options. If it is a convertible preference share, you can convert the preference shares into equity shares, and the price will also be decided at what price you can convert them into equity shares. Second one is non-convertible. In this case, the preference shares will not be converted into equity shares, but they can take their capital and exit the company as a preference shareholder. Once this maturity period is over, the preference share will be discontinued. They will not be in existence after the maturity is over. Talking about the participation in surplus profits of the company. So preference shares can be called as participating preference shares and non-participating preference shares. If the company, the preference shareholders have a right to receive the dividend. Apart from the dividend, they can also get a percentage in the profits of the company over and above their dividends. That is only in case it is a participating preference share. If it is not a participating preference share, they will only get the dividend, but they are not eligible to receive a percentage over and above the dividends, right? So this is the different types of classification of preference shares. And other one is redeemable and irredeemable, which I've clearly said that only redeemable preference shares can be issued by companies in India. Moving to the third kind of instrument, which is the debentures. Okay, so let's discuss the third instrument, which is debenture, which says that any kind of document which evidences any kind of debt or which acknowledges that a debt is due is called a debenture. Let's go into the definition which is provided under section 2 subsection 30 of the Companies Act. It says that debenture includes a debenture stock. It includes the bonds or any other kind of instrument which evidences a debt, means some kind of money is payable by the company to the debenture holder. If there is any instrument which says that the company is liable to pay any kind of money, he is a debenture holder. That is a debenture, whether a charge is created or not. So charge is nothing but a kind of security that is given to the loan amount, right? Whenever company takes a loan, they can create a charge over the asset of their company. That is, they are giving that property as a security for the loan. So by this statement, we know that the debentures can be either secured or they can also be unsecured in nature. Now, what are the features of debentures? So first and foremost, it is a certificate of indebtedness. Like I said, the main criteria is the instrument should evidence that there is a debt. So it is a certificate of indebtedness of the company. It indicates the period of redemption. That means there should be a maturity period. There should be repayment of principal as well as the interest on the fixed dates. The interest to be paid even if the company does not have profits, right? So whenever we are declaring the dividend for equity shareholders, we have to keep in mind, if there is profit, we will declare. If there is no profit, we are not going to declare. And even if there is profit, it is the choice of the company whether they want to use that money for further investment in the business itself, or they want to declare it as a dividend for the members, right? That is the choice of the board of directors. But when it comes to the debenture holders, the company has to mandatorily pay the interest even if they do not have any kind of profits. and for secured debentures, charge will be created on the assets of the company. And the important point to be noted is that the debenture holders will have no voting rights. It is nothing but like a loan, that they are going to give you some principal amount which you are going to invest in the business, and for that principal investment in the company, you are going to pay a certain rate of interest for the loan given, and on the maturity period, the principal will be paid back to the debenture holders, that is redeemable debentures of the company. Going to what are the different kinds of debentures on the basis of their convertibility. On the basis of whether a debenture can be converted into equity shares, the debentures can be classified into 4 types. One is fully convertible, non-convertible, partly convertible, or optionally fully convertible debentures. Let's discuss each one of them in detail. Fully convertible debentures. What happens in this? The debentures are issued. The debenture holder will give the principal amount to the company, and the company is going to pay the interest at the fixed period of time to the debenture holders, and at the end of maturity period, they will tell that these debentures can be converted into equity shares of the company. That is, they have an option to convert their debentures into equity shares. And this is fully convertible. That means these debentures have to be converted into equity shares. But they say that the debentures can be converted into equity shares anywhere between 18 months and 36 months. In this case, it is the choice or it is the option of the debenture holder whether they want to do it right at the 18th month when the 18 months is over, or whether they want to do it in the 20th month, they want to do it in the 32nd month. That choice is theirs as to when they want to do the conversion. When to convert can be decided by the debenture holder. It is his option, but the conversion is mandatory, where the debentures are mandatorily converted into equity shares. Let's have a look at the explanation. They are converted to equity shares on the expiry of a specified period, that is nothing but their maturity period. They can be converted into equity shares at a premium or without a premium. We know that shares can be issued at a premium as well. So that at the time when you're issuing your debentures, you can decide whether the equity shares will be given on premium or without a premium. If the duration of conversion period is given in a particular range, like I said, 18 to 36 months, it will be the option of the debenture holder as to when he wants to convert that particular debenture into equity share. For example, if conversion has to take place on or after 18 months from the allotment but before the completion of 36 months, the debenture holder can decide any date between this 18 months to 36 months as to when he want to execute his option for converting his debentures into equity shares. So it is mandatory to convert the debentures into equity shares, but when you want to convert, that will be left to the choice of the debenture holder. In such a case, the interest on debentures will be paid till the date of conversion, right? So we all know that the debenture holders are entitled to a percentage of rate of interest. And whatever is the duration of debenture, for the entire duration we have to pay them the interest, because the money is with us, that is the company. Now, if one particular investor, Mr. A, decides that he wants to convert his debentures into equity shares, so he's converting debenture into equity share in the 18th month, on the completion of the 18th month, he will get debentures only for those 18 months. If a person, Mr. B, decides to convert his debentures into equity shares in the 32nd month, he will continue to get interest till the completion of the 32nd month. So the longer the duration, for that duration you are going to get the interest rate. Once you convert the debentures into equity shares, you will no longer continue to get the interest, but you will become eligible to receive the dividends of the company. Talking about the second kind of debenture, it is non-convertible debenture, where the debenture holder will not be given any kind of right to conversion. They will not convert the debentures into equity shares. So what happens on the expiry? They have to redeem. That means they have to take their debenture amount, that is the principal amount that they've given, along with all the interest that they've received, and exit the company, because the debenture is going to no longer exist because it has expired. The issuer is required to list its public issue of non-convertible debentures on stock exchange as per the SEBI listing of debt security regulations of 2008. So if a company wants to list its debentures, it can do so, but it has to comply with the provisions of these SEBI regulations. You can also issue the non-convertible debentures on private placement basis. So in this case, we are not going to convert the debentures into equity shares. Going to an important aspect, that is partly convertible debentures. Here the debenture, one debenture itself is divided into two aspects. One is the convertible portion and one is a non-convertible portion. That means to say there is one debenture that you have, you can say 20% of that can be converted into equity shares and the remaining 80% should be redeemed. Right? So that is what is provided here, that the debentures, partly convertible debentures, have two parts. One is the convertible part and other one is the non-convertible part. In the convertible part, whatever is the percentage of the convertible portion, that can be converted into equity shares at the expiry of the specified period, and the non-convertible portion has to be redeemed on the expiry of the stipulated period. So based on what is the proportion of convertibility and non-convertibility, it will decide how many number of equity shares you will get and how much amount will be redeemed by the company. So it carries the characteristics of both convertible as well as non-convertible debentures, because both are included in partly convertible debentures. Okay, so there is a question that conversion of debenture is sole discretion of the holder of the debenture. It depends on what is the kind of debenture that the company is going to issue. If they are issuing compulsorily convertible debentures, then they have to mandatorily convert into equity share. If option is given, then it is the discretion of the debenture holder whether he wants to convert it or not. So you have to see the terms of issue as to what kind of debenture has been issued by the company. If it is a compulsorily convertible debenture, then we have to compulsorily convert it into the equity shares. Going to the optionally fully convertible debenture. So here what happens is you have a debenture that has to be 100% converted into equity share, but whether you want to convert or not is the choice of the debenture holder. Earlier what we saw was the company said that you have to convert it, but when you're going to convert it is your choice. But under these kind of debentures, choice is given to the debtors whether you want to convert it or whether you don't want to convert it. But if you opt for conversion, then the entire value of debentures have to be converted into equity shares. Here, part conversion will not be allowed, like we saw in the third category. So these are optionally convertible debentures where the choice is given to the debenture holder whether he wants to opt for conversion or whether he wants to opt for redemption of debentures. If he opts for conversion, there are certain conditions that he should fulfill. First one is that they should be fully converting the debentures. Like I said, if a debenture partly convertible, a part say 80% conversion was allowed. This is conversion, this is non-conversion. But that is not available in case it is a optionally convertible debenture. In this case, full 100% should be. I will say that if you opt for conversion of debenture into equity share, we will give you so many number of equity shares. That is predetermined. Convert on expiry of a certain period. So the conversion is going to take place at the maturity. And if the debenture holder opts for redemption, then also he has to fully redeem his debenture, and he's not going to get even one equity share, because everything has to be mandatorily redeemed and no conversion will be given. Optionally fully convertible debenture is also called as a hybrid security, as it inherits the characteristics of debentures as well as the equity shares. So if a person opts only for redemption, his characteristics are only of the debentures. If he opts for conversion, his characteristics of the equity shareholders. So in this case, this kind of debenture has the characteristics of both the debentures as well as equity shares. That is why it is called as a hybrid security and is recognized as a security the Securities Exchange Board of India. Yes. Yes. Even if a company is going under losses, it has to mandatorily convert its debentures into equity shares. At the time of issue, if they have said that it is a mandatorily convertible debenture, you have to convert irrespective of what is the position of the company. The terms and conditions of issue should be fulfilled by the company once they have issued the debentures. Right. Next, coming to the fourth category of instrument, which is a bond. Okay, bond is also a debt security. We saw in the definition of debentures that it includes bonds, right? Bonds are included in the definition of debentures. Now we are studying the fourth category of capital market instrument, which is the bonds. So bonds are also debt securities. Issuer is bound to pay a specific rate of interest, and they are required to repay the principal amount at the time of maturity. The bondholders are like the creditors of the company, and the company has an obligation to pay them. It is not a choice. They have to mandatorily make the payment of the interest to the bondholders. The bonds have generally a fixed maturity date, whether it is for a 10-year bond, it is a 15-year bond, it is a 20-year bond. The duration will be fixed. That is for how long this bond is going to be in existence. Let's take some examples. One is HUDCO, that is the Housing Urban Development Corporation of India. It has issued the N5 series of bond, the duration of which, that is the maturity period, is 15 years. The interest that they are providing is 7.51. It has already been issued, therefore the maturity period is February 2028. It was for 15 years. Similarly, the National Highway Authority of India has issued a bond which is providing an interest of 8.75 and which is going to mature in the year February 2029. So these are two examples of bonds issued by the government of India, that is under the National Highway Authority and the Housing Urban Development Corporation. Is that clear? Any doubts? Yes? Let's continue. Okay. So let's see what are the characteristics of bonds. Bonds have a fixed face value that has to be returned on maturity. Right? So this is nothing but what is the principal that you have to pay. They will have a fixed value. You have to make investment in those slabs itself. They have a fixed maturity date. Okay, it can be a few days to a few years, that may last to 20-30 years as well, right? The ones we saw were for 15 years. It can be also for a longer period. So generally it is 20 years for all the regular companies. For the infrastructure, etc., it is a slightly longer period. They have to repay the principal on the maturity period. They have to regularly make the payment of interest. That can be decided at the time of issuing the bond, whether they are going to pay it quarterly, semi-annually or annually. That will be as per the terms and conditions of the issue. And you have to check this when you are investing in the bond as to when you are going to get the payment of interest. What is the frequency of intervals at which you are going to get the interest. If they say semi-annually, every 6 months they have to regularly pay the interest on the bonds. interest is calculated as a percentage of the face value, which is known as the coupon payment for the bonds. It is nothing but the interest that you receive for the principal investment that you have made in these bonds. It is less risky when compared to the equity shares, and it helps to diversify and grow investors' money. So these are the few characteristics. So whether we get the interest per month basis or not, it is dependent upon the bonds, the respective bonds. You have to see the terms and conditions of the bonds that you're going to invest in as to whether it is quarterly, monthly, semi-annually or annually. You have to see the terms and conditions of each and every kind of bond that you want to make an investment in. It is not fixed. Now, let's have a look at certain different kinds of bonds. So bonds can be classified as firstly government bonds. By the name itself we know it is issued by the government of India or any public sector units. These are generally secured bonds which are issued by the government of India because they are backed with the security from the government. The low rate of interest when compared to the other bonds. Okay, they provide low rate of interest because generally they are secured. Going to the second kind of bonds, which is the corporate bonds. By the name we know it is the corporates, that is the private companies or the public companies which are going to make the issue of these bonds. They can either be secured or they can be unsecured. But whenever you are going to make any kind of investment in the corporate bonds, it is very, very important that we see the credit rating of that particular instrument before making an investment. What is the credit rating? Credit rating is nothing but what is the ability of the company to pay back the principal as well as the interest on time. Have they made any kind of default in payment or not? If they have made a default, the credit rating is going to be low and you should not make an investment in such kind of bonds. Whereas if you make timely payment, you are compliant with all the terms of the bond, that is payment of interest as well as the principal, then you know that it is a high credit rated instrument and you can make investment in such bonds. So whenever you're going to make an investment in the bonds of any kind of companies, it is important you see their credit rating. If they have a good credit rating, only then you should make an investment in such bonds. Coming to the third category, that is banks and financial institute bonds. These are the ones which are issued by the banks and financial institutions, and most of the bonds which are prevalent in the market are the bonds which are issued by this sector. Whether it is the gold bonds, it is the sovereign bonds, all these banks are issuing these kind of bonds. Coming to the fourth category, which is the tax savings bond. This is also issued by the government of India, which is for providing benefit for investors in the form of tax savings. So they say if you make an investment in the government bond, the income that you're getting out of this bonds, we are going to make it as a tax saving bond. It means you can deduct that particular income before paying your income tax. So it helps you in saving your taxes. Even if you have an income, you can claim deduction from the income if it is a tax saving bond. The benefit is you get a certain percentage of interest on the principal plus you're saving tax on that income. You do not have to pay any kind of tax on that income. Listed on NSE and BSE, easily liquidated, right? These kind of bonds are listed on the stock exchange. So it has transparency. You know all the details. It is available in the public domain and it can easily be traded. That is why it is liquidatable, easily liquidated. Clear? Any doubt? Yes, the bonds can also be converted into equity shares. We are going to see how is that possible, right? Yes. So let's take an example. If a company A issues bonds with the following terms and conditions, they say that the price of the bond, that is the issue price, is 1,000 rupees. The coupon rate, that is the interest rate that he is going to receive on the bond, is 2%. The maturity period is 2 years, and they say that these bonds are convertible into equity shares, and they've given the conversion price. They're saying that for one equity share, the price is going to be 800 rupees. Now, Mr. I has bought 4 bonds. He's bought 4 bonds. That means 4,000 rupees. How he's bought number of bonds is 4, and the issue price, the price of the bond is 1,000 rupees. So his investment has become 4,000 rupees. Now on maturity, what are the 2 options that are available to the bondholder? First one is he can convert his bond into equity shares. Second one is he is not going to opt for conversion. He is going to redeem his bond. That is, he is going to take the principal and interest and exit the company. In the first case, he is going to convert his bond into equity share. These are the 2 options which are available for the bondholder. But how is he going to decide? What is the criteria for deciding whether you should actually convert your bond to equity share, whether it is beneficial for you, or should you simply opt for redemption? For that purpose, we have to make a comparison between prices. What are the prices that we have to compare? We have to compare the conversion is less than the market price. We should go for conversion because we are going to get more number of equity shares for the bond. And when we go for, if by chance the market price is less, we should opt for redemption. Why? Because ultimately, if you take this amount and exit the company, with the same amount, you can invest in the market and you can buy the shares from there, where you will get at a lower value of issue. So whenever a bondholder has to decide whether he wants to convert his bond into equity shares, that is given as per the terms of issue of the bond and the market price, which is prevalent as on the date of maturity. In this, whichever is lower, we are going to select that. If conversion price is lower than market price, conversion into equity shares. If the market price is lower than, not opting for conversion, but yes, what should Mr. I do? Should he opt for conversion or should he opt for redemption? In the comparison between what in the chat box, what are into consideration for conversion of the bonds into equity shares or not? We are supposed to compare the market price on the date of maturity and the conversion price. Okay, so that is what we are going to do here. First, we are taking the conversion price, that is 800 rupees. If he opts for conversion, he is going to get 5 equity shares. How is that? He has made an investment of 4,000 rupees. That 4,000 rupees divided into 800 rupees, because per equity share is 800 rupees. So for 4,000 rupees, how many equity shares will you get? You will get 5 equity shares for... You will get 5 equity shares for the investment of 4,000 rupees. For redemption, you are going to consider the market price. The market price they have given is 1,250 rupees. The total investment is 4,000 similar. If he opts for the market price, he is going to get 3 equity shares. So the 5 is definitely better than 3 equity shares. In this case, Mr. I should opt for conversion, as he is being entitled to receive more number of equity shares for the same amount of investment, which is 4,000 rupees. Is that clear? So the bonds, whenever you get a problem where you have to decide whether a bond has to be converted into equity share or not, you should compare it with the market price and the conversion price. Moving to one more practical problem. Okay, the given data is that the issue price is 1,000, the interest rate is 3%, the maturity period is 5 years, the conversion price is 500 rupees. The number of bonds that are bought is 20 bonds, and the market price on maturity is 400 rupees per share. Now, P has 2 options that are available. One is either conversion or either redemption. If he goes for conversion, we have to take the conversion price into consideration. And for the total investment, he's purchased 20 bonds and the issue price is 1,000. So his total investment will become 20,000 rupees, which is applicable in both the cases because the investment is going to remain the same. Here the conversion price is 500. So 20,000 divided by 500, he is going to get 40 shares for the investment of 20,000 rupees. If he opts for redemption, he is going to get 50 equity shares, that is 20,000 divided by 400, which is the market price. So in this case, we will say that Mr. P should choose option B, that is he should go for redemption. Why? Because he is getting more number of equity shares for the same amount of investment. Moving to another concept, that is foreign currency convertible bonds. Now, what are foreign currency convertible bonds? Now, it is a mode of raising the capital, okay, by Indian companies. So, if the Indian company wants to raise foreign capital, it is going to use the foreign currency convertible bond, which is one of the modes. There are multiple ways by which an Indian company can raise, but one of the ways is by issuing foreign currency convertible bonds. Let's see what actually happens in this situation. There is an Indian company which thinks that it wants to raise capital, and it wants to raise capital in the foreign currency. So in this case, this Indian company is going to be called as the issuing company. It is called as the issuing company. Why? Because it is going to issue these bonds. Which bonds? Bonds which are called as foreign currency convertible bonds. So the issuing company is going to issue bonds to, these are the bonds which are going to be issued to the foreign investors. Why? Because we want to raise foreign capital. And who is going to have foreign currency? It is the foreign investors, say, who are situated in the United States of America. So what is the currency that they are going to have? They are not going to have Indian rupees. If I go to somebody who is staying in the United States and ask him to give me Indian rupees, will he have it? No, because the currency of that particular country is different. Each country will have its own currency. So if I go to the United States, it is the US dollars which are prevalent. So they are going to make investment in dollars. So whenever we are going to issue any kind of foreign currency convertible bonds, they should be in terms of dollars. They are denominated in terms of dollars. So these bonds are given to these investors who will have currency in dollars, and that is why whenever these are going to purchase these bonds, they are going to pay the principal amount, and that principal amount will be paid in dollars. Similarly, on the principal amount that these foreign investors make to the Indian company, we are going to pay them an interest, and that interest also should be payable in dollars, because if we give them in return in Indian rupees, they have the hassle of conversion of the rupees into dollars. So it is the duty of the issuing Indian company to make sure that the bonds are denominated in terms of dollars. The principal as well as the interest is also payable in dollars. Now, what happens on maturity? By name itself, we know that it has a convertible portion into it. That means these foreign currency convertible bonds will be converted into equity shares. That option will be given to the bondholders, that if they want, they can convert their bonds into equity shares. Right? And equity shares of which company will be given to them? Equity shares of the issuing company. The company that has issued the bond, the same company is going to give its own equity shares to these foreign investors. So this is the concept of foreign currency convertible bonds. We call it as foreign currency because it is denominated in a foreign currency and it has an option of convertibility. So we call it as a foreign currency convertible bond, which is issued by an Indian company and denominated in the foreign currency. And on conversion, it is the equity shares of the issuing company that is given to the foreign investors. Let's understand the concept in terms of the text. It is a kind of bond which is issued by the Indian company mainly with the objective of raising foreign investment. It is always expressed in foreign currency because the investors in the foreign country will have the currency of their own country, and keeping that in mind, we will always denominate it in the foreign currency. The principal as well as the interest is also payable in foreign currency. It carries a fixed rate of interest, and the foreign currency convertible bonds are unsecured instruments which carry an option. They can decide whether they want to convert their foreign currency convertible bonds into equity shares or not, and in case they are converting, they will get fixed number of equity shares at a fixed price. So that is, the conversion price will be predetermined. The conversion price is going to be predetermined. Now, option available at maturity. So once your foreign currency convertible bonds, we know that they have a fixed maturity period. Once that maturity is over, like the regular bonds, even they will have option of conversion into equity shares or redemption of those bonds. That also they are going to see on the basis of comparison between the figures. If bonds are converted into equity shares, the equity shares of the bond issuing company itself is given. They cannot give the shares of any other company. They have to give the shares of their own company, that is the company which has issued the bond. Same company has to give their equity shares to the bond holders. This is the concept of foreign currency convertible bonds. Now let's discuss another concept which is known as foreign currency exchangeable bonds. So the only difference between the two instruments is the word exchangeable, and in that we had the word convertible. So this also functions very similarly to that of the foreign currency convertible bonds. We will see where lies the point of difference. Earlier what we saw, there is an Indian company which is going to issue the bond. It is going to issue the bond to the non-residents. Okay, that is somebody who is staying in a foreign country. Okay, since it is in a foreign country, it is going to be denominated in a foreign currency, right? So similarly to what happens there, they are going to pay the principal amount, and we are going to pay them the interest. All this is going to be in terms of the foreign currency because we are raising foreign investment by the investments that is of the non-residents. They should belong to the same promoter group. So everything is similar, that the issuing company has issued the bond. The foreign investors have made the principal payment in dollars, and the issuing company, has paid the interest at the regular intervals in dollars. Now on maturity, what is going to happen on maturity in foreign currency convertible bonds? The issuing company is used to give equity shares of their own company to the foreign investors, but in foreign currency exchangeable bonds, it is this offerer company which is going to give the equity shares. It is exchanged. It is not of that of the issuing company that the shares are given, but the shares are exchanged for the shares of the offerer company. And in this, the offerer company should be eligible for the investment, and they should also be listed. Okay, so there are two companies that are in existence in the transaction of foreign currency exchangeable bonds. One is the issuing company and the other one is the offerer company. And on maturity, it is the equity shares of the offerer company that is being offered to the non-residents. Let's have a look at the brief explanation. Foreign currency exchangeable bond is used to raise funds from international markets. It is issued by an Indian company which is known as the issuing company. It is expressed in foreign currency. The principal and interest is also payable in foreign currency. It is subscribed by a person who is resident outside India because we are raising it from an international market. On conversion, the bonds are exchangeable into equity shares of another Indian company which is referred to as the offerer company. So there are two companies. One is the issuing company and another one is the offerer company. issuing company and the offerer company should be part of the same promoter group, that there should be a relationship that exists between the issuing company as well as the offerer company. Offerer company should be listed and should be eligible to receive foreign investment. So when the offerer company is giving an option that you can take equity shares of our company, it should satisfy two conditions. Firstly, it should be listed, and secondly, it should be eligible to receive foreign investment, because the ultimate investors are going to be non-residents of India who are resident outside India. So here the same thing, they are convertible into shares of the offerer company that forms a part of the same promoter group as that of the issuer. So the only primary difference between foreign currency convertible bond and foreign currency exchangeable bonds is the shares that you receive. In case of foreign currency convertible bonds, you're going to get the shares of the issuing company itself. In case of foreign currency exchangeable bonds, you're going to get the equity shares of the offerer company and not of the issuing company. Yes? Any doubts? Yes. So now we saw what are the modes for the Indian companies to raise money from a foreign country. Now we are going to talk about how a foreign company can raise money from India. Okay. So one of such instruments by which a foreign company can raise capital from India is by issuing Indian depository receipts. Now we know that a foreign company is there. The foreign company wants to raise capital. It wants to raise capital from India. It has made its decision. So this foreign company is going to issue its shares. Okay, and these shares are going to be kept with a custodian. Okay, and this custodian is going to be situated in the foreign country. And this is which country? It is that country where the foreign company is in existence. Because the foreign company cannot directly give the shares to the Indian resident. There are certain restrictions. That is why they think that let us issue shares and we keep these shares with the custodian of our country. Then that custodian will further give an authorization. What will it do? It will authorize the domestic depositories. These domestic depositories are situated in India. So the custodian which has the foreign company's shares with them, it will tell the domestic depository in India to authorize the payment, the issue of the Indian depository receipts to the investors in India. And the Indian investors are going to purchase the Indian depository receipts by paying Indian rupees, right? They are going to pay Indian rupees. So what happens here? The actual Indian depository receipt has no value of itself. The value of the depository receipt is based on the value of shares of the foreign company. So that by that we know that the Indian depository receipt itself does not have any value. Its value is determined on the value of the foreign company's share. If the value of the share of a foreign company increases, the value of the Indian depository receipt is also going to increase. If the value of the share falls, the value of the receipt is also going to fall. Right? So it is nothing but an acknowledgement. Indian depository receipt is an acknowledgement for the kind of investment that you have made in the capital of a foreign company. Right? So because the direct shares cannot be given, a methodology is used where the foreign company is going to issue the shares to the custodian. The custodian will then authorize to the domestic depository in India that in lieu for the shares, instead of the shares, issue the receipt is nothing but the receipt for payment that you hold a share of investment in the foreign company. So that receipt is issued by the domestic depository, which is situated in India, and the investors in India can purchase these depositories, these receipts, ideas from the domestic depository. Right? So this is the procedure how a foreign company raises money from the Indian investors, that is by the way of issue of an Indian depository receipt, which is also known as a derivative. We will see the concept of derivative. Now, let's see the definition according to the Companies Act. It says Indian depository receipt means any instrument in the form of a depository receipt, that is nothing but a receipt that is issued by the depositories of the country, which is created by the domestic depository situated in India and is authorized by a company which is incorporated outside India, making an issue of such depository receipt. So it is nothing but a foreign company which is giving directions for the domestic depository in the country, that is in India, to issue these receipts to the investors for the money that they are going to give as investment, ultimately which is going to reach the company which is situated outside the country. Let's have a quick recap. It is issued by a foreign company to raise money from India. They are always denominated in Indian currency because ultimately the investors are the Indian investors. The underlying asset is the equity share of the foreign company. By that I mean to say, if there is a fluctuation in the price of the share of the equity share, the foreign company, the price of the depository receipt is also going to increase. So the underlying asset is the equity share of the foreign company. The actual shares underlying the depository receipts are held with the overseas custodian, which shall authorize the Indian domestic depository to make the issue of the IDR. The entire process we have already discussed. The Indian depository receipts are a derivative instrument. They are called derivative because they derive their value from another instrument, which is the equity share of the foreign company. They have no value of itself. Its value is determined on the basis of the value of another asset, which is the share of the foreign company. That is why it is called as a derivative instrument, which derives its value from an underlying asset. The foreign companies which issue the IDRs also have to comply with various regulatory requirements given by the Companies Act, SEBI regulations, RBI notifications and circulars. Even if they are a foreign company, they have to abide by the rules and regulations of the Indian regulators, because ultimately it is the money of the Indian investors that is going to be invested in the foreign company. Any doubts as of now? Yes, you can let me know in the comments. We can discuss if you all have any doubts. Moving ahead to the next kind of instrument, which is known as a derivative. Okay, we already saw one example of a derivative, that is the Indian depository receipt. Now let's go into some details. Derivative is also considered as a financial instrument which derives its value from an underlying asset. So the document itself has no value. That value, the value of the document, will be dependent on any other asset, and that asset can be different on the basis of different kinds of market. Underlying asset can either be stock, it can be bond, it can be currency, it can be commodity, it can be metals, and even intangible assets like stock indices. So this underlying asset can be anything. Okay, if it is currency, it is currency derivative. It is commodity derivatives, right? So your underlying asset can be anything, and the value of the asset is going to determine the value of your financial instrument. The Securities Contract Regulation Act defines the term derivative. Okay, you can go through the definition. But I've explained the concept. It does not define what is derivative, but it only gives a list of instruments which are considered as derivatives. Derivatives can be different types like futures, options, swaps, caps, floors and collars. But the main kind of derivatives that are prevalent are the futures and options, which we are going to study in detail, and your entire syllabus resolves around futures and options from the point of view of practical problems. So we will discuss a few of the practical problems as well. Okay, talking about first the futures contract, which is a kind of derivative, and its underlying asset can be anything. It can be commodity, it can be currency, it can be stocks as well. So future contract is traded on the stock exchange, and it is a forward contract, means it is for a future period in time. Okay, for in future you want to purchase something, but today only you are going to decide what is the quantity, what is the price, and what date, okay, you are going to execute it. So it is traded on the stock exchange. It is for the purpose of either buying or selling any, whatever, whether it is the stock, whether it is the commodity, whether it is the currency, whatever is the underlying asset, we are entering into a contract to buy or sell that particular asset. What is decided today only? It is decided how much quantity you want to buy, at what price you are going to buy, and when you are going to buy. So for purchasing something 3 months from today, today only we are going to decide how much we are going to buy after 3 months, how much what is the price that we are going to pay for that asset which we are going to buy after 3 months, and the future date is that we have decided it is for 3 months. So the quantity that you're going to purchase, the price at which you're going to purchase, and the time when you're going to purchase, all these three things are decided right at the time when you enter into a contract, right? So these contracts are standardized contracts because they are listed on the stock exchange. That is why they are in the standard form, and it ensures there is liquidity. So we know that it functions over the stock exchange, so there is easy buying and selling of assets. So the futures can also be easily bought and sold. So now there are two positions that you can take in a futures contract. If you are saying, okay, if you are taking a long position, that means you're purchasing a future contract. The buyer is agreeing to receive the delivery of the underlying asset, that whether it is a stock, it is a indices, it is commodity, it is currency, whatever is the underlying asset, the buyer is agreeing to receive. Short position means you're selling the futures contract, and in this case the seller is ready to make delivery. That means he has to give it, he should hand it over to the buyer. So he's agreeing to make the delivery of the underlying asset. So these are the two positions that you can undertake in future. Either you're going to buy it or you're going to sell it. When you're going to buy it, you're going to add something to the already existing list that you have. So your list of investment is going to become longer. That is why you're taking a longer position. If you're going to sell something, you already have something, but when you're selling, it is going outside your bucket list. So it is going outside. That means the list is becoming short. So you're taking a shorter position by selling off the things that you have. Right? So either it is a long position or it is a short position. Currency futures, so it is the same thing where the underlying asset is a currency, then we call it as a currency future, where the underlying asset is a currency. So currency future is also known as FX future, which is the short form for Forex. Forex is nothing but foreign exchange. So currency future is also a kind of futures contract which we discussed, where you exchange one currency for another currency. Similarly, there we were buying and selling, no? Here also we are exchanging either selling one currency and buying the other currency, or the other way round. So here the underlying asset is the currency. But what are we going to decide? Similarly, like we saw in the futures, we are going to decide what is the quantity of currency that we are going to purchase or sell. We are going to decide at what price we are going to do it, that is the exchange rate at which we are going to exchange the currency, and at what time in future we are actually going to exercise this transaction. So all these things are fixed on the purchase date, purchase of your currency futures. On the date when you enter into the futures contract, that day itself, this price, quantity and future date are determined. So this should be determined when you purchase the futures contract. The price of futures contract is in terms of INR per unit of another currency. The currency future contracts allows the investors to hedge against the foreign exchange risk. So all of us know that the currency of one countries to other country keeps on fluctuating on a daily basis. So to avoid that fluctuation in the prices of the two currencies, they enter into this currency futures where they determine the price much in advance so that they can be prepared for such payment. The currency derivatives are available in 4 currency pairs: US dollars, euros, Britain pounds and Japanese yen. So as on today, can anybody tell me how much of Indian rupees required to purchase $1? Yes, can anybody tell me? Rupee per dollar. This is fluctuating figure, so every day you will get different figures. So as on today, if you want to buy $1, you have to pay 79.68 rupees. Similarly, if you want to buy a euro, for €1, you have to pay 79.05 rupees. Similarly, if you want to buy a pound, for £1, you have to pay 90.91 rupees. Similarly, if you want to buy a Japanese yen, for £1, you have to pay 0.56 rupees, which is less than 1 rupee, right? So these are the currency pairs that are available on the stock, fluctuating on a daily basis, and to avoid the fluctuation in currencies which is going to impact the businessman, because assume a situation where there is an importer and there is an exporter. Say is a foreign person. The payment that is required to be made and received will be in different currencies. The exporter is in India, so he will have Indian rupees. The importer is in a foreign country, can be a different currency, that is yen, right? It is in yen. So in this case, whenever you are entering into business contracts, these contracts are worth crores of rupees, and even minute of fluctuation of 1 rupee is going to cost a lot to the company. To avoid those fluctuations impacting their cost, okay, whenever we are entering into contract, the contract price is a cost to the company. So you can control the cost of the company by ensuring that you have fixed the price at which you are going to execute a particular contract. That is, the exchange rate is fixed. It will not fluctuate. So today you are entering into a future contract that 3 months hence you are going to exchange rupees for yen at 0, and on the 3rd month the market price of yen is say 1.56. so here the 6 difference is there. So such minute details are also costing crores of rupees to the companies. So these future currencies contracts help the company in setting off the fluctuations in the currency prices. Coming to the options contract. Options contract is also similar to that of the futures contract. In future contract, what happens? When you enter into a future contract, there is a buyer, there is a seller. Obviously, when it is listed on the stock exchange, either you are a buyer or a seller. In that case, you have an obligation. You have an obligation to fulfill that. If you have agreed to buy, you will buy it. If you agreed to sell, you have to sell it. But that used to sometimes lead to a lot of losses. Suppose as on the conversion price or as on the date when the strike price, the price as per the futures contract is 100 rupees. When you are going to buy something, the strike price, that is the price as per the contract, is 100 rupees. But when you see 3 months hence, the market price is 80 rupees. In that case, if you have to go as per the future contract, to buy it, you have to pay 100 rupees, even if it is available in the market at 80 rupees. In this case, the person who is entered into a future contract is definitely going to face a loss of 20 rupees, right? That will amount to so many rupees. So in this case, there was a drawback that whether the person is facing a loss or whether he is having a profit, he has to fulfill his obligation of whatever is mentioned in the futures contract. To set off this disadvantage of futures contract, they have brought into existence the options contract. What is the options contract? We are going to see in detail. So the option contracts is divided into, has 2 parties. One is the option holder and one is the option writer. Okay, the option holder has a right to take or make the delivery, and the option writer will have the obligation to take or make the delivery. So here, because he has a right to exercise, he is the person who is going to decide. What is he going to decide? Whether I'm going to execute this contract or not. He has the power to make that decision. So he will pay a sum of money which is known as the option premium. So the option holder will have a right to decide whether he's going to exercise the option or not, and because he has a right, he's going to pay a certain sum of money which is known as the options premium. And the option writer has the obligation. That means whatever is the decision of the option holder, it has to be heard, fulfill it. Therefore, he has an obligation and the risk of making good the obligation. That is why he is going to receive the premium that is paid by the option holder. So as the option premium. Even in the options contract, like the future contract, the quantity, price as well as the future date are predetermined. Okay, you're going to execute it on a future date, but the quantity, price as well as the date is decided much in advance when you're entering into such a contract. Now, there are two types of options available. Other one is called as a call option. It's defined in the options contract. That is the choice that is given to the option holder. And when he is to decide that, what are the factors that he should take into consideration? Car, Mr. A is offering 5 lakhs to buy the car from you. Mr. B is offering 5.65 lakhs to buy the car from you. From whom are you going to purchase it? Can you tell me? Put it in the comments. If somebody is offering you 5 lakhs to buy your car and somebody is offering you 5.65 lakhs to purchase the same car from you, to whom are you going to sell that particular car? Yes, you can let me know in the comments. Bring us more value, and that particular phone is available at 1,35,000 rupees, at website B for 1,30,000 rupees, and in the showroom you're getting it for 1,40,000 rupees. From where are you going to buy it? You're going to buy it from website B. Why? Because that is quoting the least figure. It is quoting the option and call option. Because the right to sell is in the put option, we are going to discuss the put option first, where we are going to make comparison between what? Between the strike price. Now, what is the strike price? Strike price is the price which is determined as per the terms of the options contract, and we are going to compare that with the market price which is prevalent on the date of maturity of your option. So we are going to compare two figures. One is the strike price and one is the market price. And since we have a put option, whichever is higher, if the market price is higher, we are going to go by the market price. And if the strike price is more, we are going to go as per the strike price and exercise the option, right? So if the strike price is more than the market price, the option will be exercised. Right? And if the strike price is less than the market price, that means the market price is more, we are going to select the market price. That in that case, we are not going to exercise the option. Option is not exercised. The option holder, whether he wants, firstly, he should see whether it is a put option or a call option. If it is a put option, he should always go for that figure which is higher, because he is selling it, he will sell it at a higher value. If the strike price is higher, we will exercise the option, but if the market price is higher than the strike price, we are not going to exercise the option. Let's come to the buy, that is the right to call. That is the call option. In this, we are going to compare the strike price with the market price on the date of maturity. So right to buy means we are always buying at a lower value. So if the strike price is more than the market price, we are going to go by the market price, because market price is lower. In this case, we are going to exercise the option. And in case the strike price is lower than the market price, we are going to select the strike price. In that case, we are going to exercise this option. In this case, it is not exercised. So whenever it is a call option, we are going to see which is lesser and we are going to go by that. Whenever we have a put option, we are going to see which is higher and we are going to go by that. If you select the strike price, that means you are exercising the option, and if you go by the market price, that means you are not going to exercise the option. Is that clear? So this is just a gist of what we have discussed. Whenever there is the buyer of the option or option holder, he has a right, and the option writer will have an obligation to do the opposite of what the holder is doing. And call option is the right to buy. That means you buy at a lower value. Put option means you have a right to sell. That means you're selling at a higher value. The option writer is always having an obligation, and because he has an obligation, he is getting an extra payment for that, which is known as the option premium. Option holder, on the other hand, will have a right to make the decision whether he is going to exercise the option or not, and because he has a right, he is paying a certain sum of money, which is the option premium. Now, so this is already discussed, and we have already discussed the higher value and lower value for how we are going to exercise the option or not to exercise the option. So this is a brief gist that you have to see who is the option writer and who is the option holder. Secondly, you have to see whether it is a put option or it is a call option. You should see the comparison between strike price and the market price. On the basis of these factors, we are going to decide whether an option is going to be exercised by the holder or not. There are two types of options available. One is the European option, other one is the American option. As per the European option, the options contract can be exercised only on the date of expiry, on the date of maturity, and we as the country, Indian stock exchanges follow this European style. And there is something called as the American option, where the option can be exercised on or before the expiry date. Okay, so briefly I've mentioned the difference between options and futures. In the futures, both the parties are under an obligation. You have to fulfill the terms of the futures contract. In options, only the seller, that is the seller, option writer, is under the obligation, and option holder has a right. In futures, because both the parties are under an obligation, there is no concept of payment of premium. But in options, because the option holder has the right, he will pay the premium, and the option writer will receive the premium. So these are a few differences. Let's take one example. Mr. E writes a put option. So in this case, we can identify that Mr. E is the option writer, and he has a put option, means that he has a right to sell. The exercise price is strike price, which is 350 rupees, and because he has purchased this put option, he is going to pay a premium because he is the option writer. Okay, so whether he is going to receive it or pay it, can you let me know in the comments? That in this case, Mr. E, who is the option writer, whether he will get the premium or whether he has to pay the premium. In this case, because he is the option writer, he has an obligation, and whenever he has an obligation, he is going to receive the premium. So in this case, Mr. E is the option writer, so he is going to get the payment of 10 rupees. The share price on the expiry of the option is 320 rupees, that is the market price. Now let's see whether Mr. E is going to have a loss or profit out of this particular transaction. Mr. E is the option writer, all of us know. That is why he is going to receive the premium. He has written a put option, but we know who has the right to make the decision. It is the option holder who has a right to decision. So we are thinking from the point of the option holder. The option holder has the put option. Put option means he has a right to sell a particular asset. When he's selling, he will sell it at a higher value. We all know we have to compare the strike price with the market price. Strike price is 350 and the market price is 320. So he's selling, he wants to sell it to the option writer. So the option holder will exercise his option. In this case, Mr. E is the option writer. That means he is under the obligation to comply with what Mr. option holder has decided. So in this case, option holder has the right to sell. So there becomes an obligation of the option writer to buy. So in this case, Mr. E has to mandatorily buy because the option price. And because of which the option writer is going to face a loss because he has to sell it at, he has to buy the particular asset at 350 rupees where he could buy the same thing from the market at 320 rupees. So he has a loss of 30 rupees. But however, we know that because he is an option writer, he is agreed to face this loss, he is agreed to take this risk, he is going to receive a premium of 10 rupees. So his net loss will become 20 rupees. So he has suffered a loss of 20 rupees. Is that clear? Yes. Let's take another practical problem where it says Mr. R pays the premium. So he is paying the premium. So we know only the option holder is going to pay the premium. So here the designation of Mr. R becomes the option holder. He pays a premium of 90 rupees. To purchase the right to buy. Right to buy will have in which option? In call option. Price of 2,200 rupees. So in this case, let's see, Mr. R himself is the option writer. So whether he's going to exercise the option. So he's not going to undertake the loss by buying it at a higher value. So he selected the market price paid. You have to take two factors into consideration. One is profit and loss. Other one is the premium paid or received. When the option is not exercised, we are going to take only one factor into consideration, that is the premium, because there cannot be any loss because the option holder will not select the option which will take him towards the loss. So there is no loss or profit in that particular transaction. So we are only going to consider the premium in case the option is not exercised, that is going from the hands of the option holder, which will become the loss of that particular transaction. Right? Currency derivatives I've already discussed. It is in currency pairs that you buy currency in the figures of other. The underlying asset is currency pairs, like I discussed. It could be rupee per dollar, it could be rupee per euro, it could be rupee per yen, whatever for the Indian markets. Forex rates are value of foreign currency relative to the domestic currency. The major participants are banks, corporations, exporters and importers. Mainly this is useful for these category of investors. Commodity derivatives, when the underlying asset is any commodity. The commodity can be anything. It can be a metal like steel. It can be a spice like turmeric. It can be any kind of pulse. It can be cereals like wheat, bajra. Okay, it can be any kind of oil seeds. All these are different kinds of commodities. The value of these commodities will determine the value of the commodity derivative. Okay. So mainly for those companies which are into, say, manufacturing or producing food packages, whether it is chips, whether it is any kind of snacks, they will require these spices, they will require oil, they will require so many different products. In that case, they will enter into these commodity derivatives where, to avoid the fluctuation in the prices of the commodities, they are going to fix that we are going to buy so much quantity and at so much price on a future date. They are going to buy a particular commodity. Suppose it is a potato chips making company. How many potatoes they will require? How many liters of oil will they require? So to avoid the oil fluctuation prices in the market, for a future date, they are deciding today itself how much quantity and what is the price at which we are going to buy. Commodity trades in spot market. Spot market is today you go to a store, pay the money and buy the product. That is spot market, that is the physical market. Futures market and forwards market are where you enter into a contract today, but you're going to purchase that particular commodity on a future date. You're going to enter contract today to be purchased on a future date. The difference between forward market and futures market is forward market is trading over the counter. That means this is taking place over the stock exchange, whereas forward market is not over the counter. It is between the parties. Only both the parties are there, the buyer and the seller, whereas in this it is regulated by the stock exchange. Right? Coming to warrants. Warrant means an option which is issued by the company whereby the buyer of the warrant is granted the right to purchase a set number of equity shares of the company at a given price during a given period. So by this, they are deciding, the warrant holder will have a right to decide. What is the right to decide? It is to decide whether you want the equity shares or you don't want the equity shares. If you want the equity shares, we are going to exercise the warrant. And in case you don't want the equity shares, we are going to lapse the warrant. Right? So here the warrant holder will have a right, he is granted a right to decide whether he wants to purchase the number of shares on a future date. Right? He has a right to decide whether he is going to purchase equity shares on a future date. But the price is determined today itself. Here, he has a right but not an obligation to convert the warrant into equity shares. It is optional conversion. The options available to the warrant holder are conversion of warrant into equity shares or letting the warrant lapse. And this is also decided on the similar basis like we saw for option, where we are going to compare the strike price or the exercise price with the market price. If the exercise price is low, we are going to exercise the warrant. If the exercise price is high, we are going to let the warrant expire. Similarly, we'll just take an example. They have said the conversion price is 70, that is nothing but the strike price, and the market price is 110 rupees. In this case, the investor will convert the warrant and enjoy the capital gain when he is getting the same shares worth 110 rupees at merely 70 rupees. He will definitely exercise that particular warrant. Coming to the example 2, the conversion price or strike price is 70. The market price is 40 rupees. In this case, the investor will let the warrant lapse because when he is getting the same product in the market at 40 rupees, why will he pay 70 rupees for the same product? Who will pay higher value when the same thing is available at a lower value in the market? So in this case, the investor will let his warrant lapse. So we have to compare the conversion price or strike price with the market price. Whichever is less, we are going to opt for that. If we are going to select the conversion price, that means we are exercising the warrant. That is, we are taking conversion. And in case the market price is less, we are letting our warrant expire. Right? That is nothing but lapse. Right? Any doubts? Is it clear? Okay. Let's go further and see the last few instruments, which is the real estate investment trust. The real estate investment trust is a collective investment scheme that owns, operates or finances income producing a real estate. The REITs provide all investors the chance to own valuable real estate. They provide investment opportunities to those investors who do not have large sums of money to buy land, building, etc. So why has this concept of real estate investment trust been brought into force? Buying a real estate property, whether it is a commercial building, whether it is a house, whether it is a plot of land, is extremely expensive. It is capital intensive. That is, you have to pay crores of rupees to buy those real estate properties. In metro cities, obviously it is in crores of rupees. Now that there are so many schemes for the development of tier 2 cities, tier 1 cities, there also the real estate property values have increased considerably. So when the investment in the real estate sector is so capital intensive that you want crores of money to buy a particular asset, they came up with an idea that you can buy a part of the property. If the property is so big, it is so huge, a part of the property ownership we can give it to you. So they've said they've treated this entire property as the capital, and part ownership like a share is being given of that particular property. This is the concept of REIT, where when you cannot invest in an entire building, you can make a small investment and become the owner of that particular building of a small percentage. Let's see how the system works. Now there are various investors. They want to make an investment in the real estate sector, but they do not have lots of money where they can buy the entire property for themselves. So they decide, let's make an investment in the REITs. So what are they going to give? They are going to give the cash that they have, that they want to make an investment, to a real estate investment trust, which is established in the form of a trust. So this is going to pool in all the money of the investors. So like this, if there are crores of investors and each person is going to give 1 rupee, they will get 1 crore automatically, right? So they are going to collect a lot of money from a lot of investors and invest that pool of money in buying the real, so small amount of money ITs from various investors, and all that money together collectively is invested in the real estate property. So for the cash that we are going to give the REIT, that we have made a payment in this particular, for that they are going to issue us some units in there and buy the units of the REIT. The money that we give as cash is invest real estate sector in buying different commercial property, residential property. It can be office spaces, kind of income generating asset. So that is the important criteria, that they should make an invest generating real estate property. Okay. So all the money. Now when the REITs buy these properties, they are the owners of the property, so they will get the income out of that property. So if it is an office space, you will get rent. If it is a residential place, you will get rent. If it is mall also, the people who have taken shops in that particular mall will pay you rent. So you will earn income by the way of rents that you receive, whether it is rental income, lease income, whatever. But there is some kind of constant income that you're getting out of that real estate property. Apart from that, the value of the property also appreciates over the time. When the place is developing, it is going to impact the price of the property itself. So you're going to earn by the way of rental income as well as appreciation in the value of the property. So this is the income of the REITs. Now as investors, you have paid cash and you have received the units, but will you not want a return on your investment? Simply will you pay cash and sit without returns? You will also require some returns. So for that, REIT has to pay the income that it earns to the investors in the form of dividend, and that is the returns that the investors are going to earn. That is in the form of dividend returns. And another kind of return that the investors can make is by price appreciation. If today you have bought 1 unit at 300 rupees and later REIT is functioning well and there is a lot of demand for the units of REIT, the same unit might be of 400 rupees, right? So there is a appreciation in the value of 1 unit of REIT. So there also there will be a price appreciation that you can earn. So the return for investors will be on constant dividends, that is the rental. Sell their investment, there will be price appreciation through which they can also make money. Right? So this is the concept of REIT, where the trust is going to collect the money from n number of investors. That cash is going to be used to buy the real estate properties. The properties bought, okay, from that whatever income is generated, that will be coming in the name of the trust, and the trust is going to pay back that as a return to you for your investment. So here the investor has no stress about buying the property, about paying the taxes, about ensuring whether the rent is received on time, it is not received, the legal documentation. All this is not the responsibility of the investor, but it is of the real estate investment trust. So here the only duty the investor has to do is pay the money and get the returns. So that is why there are a lot of advantages of real estate investment trust. Firstly, it is less capital intensive. Like I said, if you go to buy a house for yourself, you yourself have to pay crores of rupees. But if you make an investment in the real estate investment trust, a mere investment of 10,000 rupees is also sufficient to have a percentage of ownership in an entire property. So it is less capital intensive, and the shares of REIT or units of REIT are very affordable. It is suitable for small investors because you don't have to deal with big builders. Okay. There is a lot of transparency because all the REIT units are listed on the stock exchange. All the details are available in the public domain. So it is a very transparent system. You have assured dividends. Why? Because the dividends that you receive are nothing but the rental income that the REIT earns. So rental income is constant. Every month you receive it. So the dividends that you receive will also be kindly assured that you will definitely get dividends out of the investment that you make in REITs. Tax free, okay, the dividends that you earn or REIT is also declared to be tax free. Fast capital appreciation, okay, the value changes. Easy to buy, like I said. If you yourself have to go and buy a house for yourself, you have to go and see what are the amenities, who is the builder, what is the quality with which the house or the building is constructed. So many paperwork, whether the paper is correct, whoever is the buyer, what is the chain of buyers, whether it is the first, he's the first owner, he's the second owner of the property. So many things are required to be checked when you yourself are going to buy a property, which is a very difficult, cumbersome and time-consuming procedure. But if you must have to pay the money, and it is the trust who is going to find which property to buy, where to buy, which location to buy, and all the legal work will also be undertaken by the trust itself. So it is a very easy and less cumbersome procedure to make an investment in the real estate sector. Yes. Coming to what is the minimum of investment, it ranges between 10,000 to 15,000. Earlier it was over and above 50,000. Now SEBI has reduced that and made it to 10,000 rupees. Income for REIT, like I discussed, it is capital appreciation and rental income. The same thing has to be given as a return to the investors in the form of dividend, and they will also earn price appreciation. But one advantage is that it has been cleared that 90% of the net income of the REIT has to be mandatorily paid out in the form of dividend. That will nothing but it will give you a assured dividend. Right? You have a constant income. A few examples of REITs are Brookfield India Real Estate Trust, Embassy Office Parks and Mindspace Business Parks. So these are the three real estate trusts which are listed on the stock exchange in India. Moving to the Infrastructure Investment Trust, it is exactly similar to REITs. In REIT, we are going to invest in the real estate sector, whereas in the infrastructure investment, we are going to invest in the infrastructural development of the particular place, wherever they are making the investment. So everything else is similar. The pooling of funds, the making the investment, everything is similar. The only thing is different, that is the objective with which they are created. That is for the real estate sector, and this is to promote the infrastructure sector of India by asking more individuals to make investment in InvITs. Coming to the last but one instrument, that is the securitized debt instrument. The entire securitized debt instrument is based on the concept of securitization. Okay, let's understand the concept of securitization first before we understand what is a securitized debt instrument. All of us know that the banks and financial institutions provide loans and borrowings to the individuals, to the companies, to the businessmen, so that they can undertake their business activities. But once bank makes this payment to these business houses or individuals, the money of the bank is blocked. It is blocked, right? It is not liquidated in the market because it is stagnant. It is stuck over a particular place. Now, to avoid this blocking of funds with the bank, they have come up with the concept of securitization, which is as follows. Now, the borrower will take the loan from the bank. That is, the bank is giving loan to the borrower, and for the loan taken, the borrower is going to pay certain installments, that is the EMIs, for the loan that he has taken, right? And generally this used to be limited process. Time and again they used to pay loans, and once the loan period is over, the borrower has to, obviously over the period of time, EMIs are paid and the loan is cleared. But the bank had to wait for 20 years. If it is a home loan, it is generally for 20 years. So for 20 years that money is with the borrower, and the bank has no funds with itself to undertake the banking activities, to keep liquidity of money in the market. That is why they said, what if the bank sell the receivables? Receivables of the bank is nothing but EMI. What if the bank sells its EMIs to one company and take the money in return for that? So what happens? The bank pays the loan to the borrower. The borrower generally pays the installment to the bank, but bank decides that I am going to sell all my EMIs to a special purpose vehicle which is known as the securitization company or the asset reconstruction company. And once it sells its EMIs, it is going to get cash from that company, and that cash, this blocked money, is coming in the form of cash, so there is no blocking of funds. There is sufficient cash with the banks to undertake liquidity activities in the market. Now, what will the special purpose vehicle do with these EMIs? It does not want to block its funds. If it wants to buy EMIs of the bank, it has to pay cash. From where will the cash come? So much volume of cash. That is where the small investors are included. Construction companies too, they will convert the debt, that is the EMI receivable by the bank, into securities. This step where they are converting the receivables into securities is called as the securitization procedure. The loan of the bank that it has to receive, it is the asset of the bank is converted into securities, right? So the debt is converted into securities, and this work is done by a special purpose vehicle, and this conversion of debt into securities is called as securitization. And this securitization company will sell those securities to the investor, nothing but shares. Procedure: receivables are converted into securities. The EMI payments that are required to be made to the banks, that will have to be made to the special entire cash of EMIs through the special purpose vehicle. So the borrower also, if it pays, it will become double money for the banks. That is not possible because it has already sold its receivables to the special purpose vehicle. All the payment of installments after the securitization procedure is over will be received by this special purpose vehicle, and all the receivables that they receive in the form of installments, that will be paid to the investors as periodic returns for the investment that they have made in securities. So the borrower will take the money from the bank. The bank will sell its receivables in the form of EMI to the special purpose vehicle. Special purpose vehicle will convert that debt into shares and sell it to the investors. The investors will want some return out of the investment that they are making, and that investment of the money that the borrowers are going to pay back the special purpose vehicle, and the special purpose vehicle is going to distribute that to the ultimate investors, who are the security regulated also by the security invest. The concept benefit of introducing these kind of instruments ensures liquidity in the market because the funds of the bank are released. That is why it is creating liquidity in the market. It lowers the interest rate because more the money available with the bank, the lower will be the interest rate, right? It ensures lending for reasons other than free up the capital for the banks. That is nothing we should these responsibility to fulfill. And where will the money come? It is the regular investors like you and me who can make an investment in bonds. It works similar to the concept of bonds that we have studied some time back. The same concept will apply here. It is just of urban and under month of December. Yes. Is there anything that we have to discuss? Okay, if you all have any doubts, if you all have any queries, you can connect to us on 973-973-3400 and we will answer all your queries. So that's it for now and see you all soon.